If you've planned well, did a good job saving, and had a little bit of luck, chances are you will leave some assets to the people you love. Today, the worst asset to leave to your heirs is a traditional IRA or 401k account. Unfortunately, for most people, it is the single biggest asset they accumulate. We're going to tell you why this is now the case and what you can do about it. Hello, welcome back to Wealth Wednesday, our bi-weekly show to help you make better decisions about money in your life. You can catch up on past episodes at our YouTube channel. That's at Commonwealth Financial. And if you'd like to learn more about us, the Ohio Valley's financial planning firm, check us out on the web. That is cfswv.com. Joining me today is newly minted certified financial planner professional Vince McManus, who recently completed all of the requirements to earn that designation. He, along with our paraplanner Tyler Zaffron, now make 7 certified financial planner pros on the Commonwealth team. Vince, congratulations on that milestone and welcome back. We're going to talk about why a traditional IRA or a pre-tax 401k account is the worst asset you can leave your non-spouse beneficiaries. Vince, tell us why that is.
Sure. Neil, not too many years ago, around 2020, a non-spouse beneficiary could spread out required distributions from an IRA over their remaining life expectancy. So what that means is that in general terms, the account had to be liquidated around the time that you reached maybe 85 or 86 years old. So if you were 45 when you started, you had 41 years to liquidate the account, and then the taxes would be spread out over that time as well as the distributions. So in 2009, during the budget negotiations process, which is something we won't get into because it's Congress and it's too crazy when we're talking about DC, but what we'll say is that law changed. So now, for most non-spousal beneficiaries, the accounts must be completely withdrawn over a 10-year period. So what that does and why Congress did this was to help pass through some tax cuts based on budgetary rules, is that it greatly accelerates the tax bill due on those assets.
Yeah, and my textbook example of this is an inherited IRA that started back in 1992. It's still in existence today, and it's still worth close to the original amount of the original inheritance. It has about 10 years left to go before it is completely distributed. So here's how this changed. Under the old rules, if you had an inherited IRA worth about $500,000 at age 45, and assuming a hypothetical 5.1% average annual return, if the beneficiary only took out the minimum, after 10 years, the account would still be worth about $600,000. And if you use these assumptions, it's still worth the original inheritance nearly 34 years later. So from an inheritance to final liquidation at 85, total distributions would have been roughly $1.6 million. Under the new rules, the owner has liquidated that account in 10 years. They will have received $632,000 of total income. So if you compare the total two taxes of the two methods, using a 24% federal income tax rate, the account owner would pay more than twice as much in taxes under the old rule, but receive 3 times as much income. It just took a lot longer to get there. Vince, it's a bad asset to leave now. What are some of the things that we can do to solve this problem?
Sure. The most obvious one to think about is converting some of these pre-tax IRA or 401k funds to a Roth IRA. Okay, so what you have to do when you're doing that is you have to look at and compare the tax situation of you, the account owner, and then your kids or whomever is receiving the funds. So it creates quite the planning opportunity, but it's not something that's just a one-size-fits-all strategy. So if your children are successful, higher earners, doing conversions probably makes a heck of a lot of sense, right? If your kids are in a lower tax situation, it may not be a good strategy. And then if we have what a lot of us with kids understand is our children end up being situated very differently. So it may be, hey, let's split these up, do some conversions to leave to the higher earner, leave some of it in the old one. So it really is something that is something that someone who is a planner can help with, but it's not something that you just want to jump in and sort of do yourself. If you've read something on the internet, there can be some times where it just doesn't make sense to do it. But like my overarching thing is what I look at when I think about this is like you're trying to pull the tax rate forward and pay the taxes for your kids. So if you view this as like over 2 lifetimes instead of one, which for some families, frankly, it's hard to think of it that way. But for the most part, if you have someone that is on board and thinks of this as totally as, hey, I want to pay the least amount to Uncle Sam over my lifetime and my kid's lifetime for this bucket of money, it can be a very, very strong strategy to help achieve that goal and make sure that the people that you want to keep more of the money actually get to keep it versus the federal government and state government.
So, and if you're still in the accumulation phase of life, you should really look at using the Roth 401k, Roth IRA, whatever type of plan you are contributing to as your primary choice in that. And there are a few circumstances where those pre-tax contributions can make sense, but by and large, if you're paying the taxes up front and allowing that to compound in a very tax advantaged way, it's going to work out. So couple things where you want to maybe still look at the pre-tax thing that we've seen. If you're at the upper end of that 24% tax bracket, meaning if you're a married couple, you're talking about $400,000 of taxable income or starting to cross over into that 32% bracket, the pre-tax thing may still work out for you. If you're a business owner, that qualified business income deduction in certain industries can be phased out or eliminated, and you want to watch that very carefully as well. But the key thing in all of this is the compounding factor, and whether you're converting it after you've retired or you're making those contributions before you retire while you're still accumulating assets, it's the compounding that really makes this a huge impact on your family down the road. Vince, I'm not always the biggest proponent of life insurance, but it can solve some problems in some instances. A life insurance policy can help people with these large pre-tax IRAs as well, can't they?
It surely can. And again, this goes back to it goes back to the change in the distribution strategy. And it's very interesting. It's why like keeping up with current changes always has to happen, because if you're really digging into the planning, things that make sense stop to make sense, and then sometimes they come back again. And that's exactly what's happened here with life insurance. If we go back to the late 90s, early 2000s, life insurance planning made a lot of sense because the estate tax amount was so low, less than $1 million. So a lot of families were getting caught up into that. So a great way to deal with it was life insurance because the proceeds are non-taxable. Okay, so as that changed and the exemption for estate taxes has gone up, I think it's around 13 million now. So most people aren't even worried about that. Well, that life insurance planning went out of favor. Well, go back to the 2019 tax law change, and potentially because of how they changed the IRA taxation, it's like, hey, maybe we need to start thinking about life insurance again. And that's kind of what happened. So again, life insurance benefits are not taxable to the beneficiaries, and life insurance benefits also allow you to provide a bigger benefit than what you pay in premiums if done right. And that's sort of what part of the linchpin is when you're doing this planning. So two ways to approach it. Withdraw funds if you're in a lower tax bracket to fund the premiums, or if you're healthy when your RMD start, which is required minimum distribution, and you don't need that income that the government is making you take to meet your normal expenses, well, you can use all or part of that RMD to fund the life insurance policy via the premiums. So if nothing else in that instance, it would replace the taxes that will be due on whatever your heirs have to pay. And again, the devil's in the details there, because depending what the underwriting looks like, depending how much of a policy you can get, the numbers can sometimes be where it's like, hey, a no-brainer, let's jump and do this, or nah, this just isn't going to make sense because the numbers don't work based off of what you can qualify for, and then how much the premium is based on lifestyle factors when you're trying to qualify for the policy.
Right, and that's kind of the big fly in the ointment, if you will, with this, right? You have to be insurable and at reasonable rates to boot, which as you get older, that becomes a bigger and bigger challenge because our health does not always stay as good as it is when we're starting to think about this. There's a couple different strategies that you can use with this. And probably the biggest one that people don't often think about is a second to die type life insurance policy where you're considering the lives of two people, and it only pays out when the second of a couple passes away. But that may be a way to solve some of the underwriting issues in that. But it's worth investigating. It's worth at least looking at some of those details if it's a legacy planning type situation for you. Vince, this is a complex area. What are some final thoughts you can share with us today?
Sure. Final thoughts is come in and talk to us. This is the kind of stuff like I would classify myself, and I feel pretty comfortable classifying Neil as this is we're kind of dorky. We can take it as a compliment, right? This is the kind of stuff that kind of gets our brains thinking. It's something that I care about deeply because it's one of the things that I think one the general public doesn't think about too much, and it's something that we can control whether it happens or not. At times in our business, like the market's great, the market's bad. It's somewhat out of our control. Things like this are opportunities that present themselves based on if the market's great or if the market's bad. Hey, there's times where this makes more sense. So it's something that we can really play offense on when it makes sense, or sometimes play defense. So it's an area that we like to operate in because we think we can add a lot of value to families overall in terms of, like I always say, making sure that their intended beneficiaries receive more money than the unintended beneficiary, which is the government.
Vince, thank you so much for joining me today. This is a very deep topic. And if you'd like to get in touch with Vince, myself, or any of the other planners on our team, visit us on the web at cfswv.com. Thanks for watching. We'll see you soon.